Hi, everybody. This is Dan Sheridan, and I'm going to give you 6 strategies that you can have in your golf bag, your arsenal of trades for a small account. All of these trades are $500 or less. Most are in SPX, some are in SPY. These would be in the range bound part of the portfolio. I'll also cover a trade, a kind of a poor man's covered right, but all of these are wonderful because you can trade in what I think are the best vehicles out there, SPX and then SPY. They're well diversified vehicles. Vehicle SPX is 500 stocks in it. Tremendous liquidity, trade a lot of options, you get good execution. And I think if you want to learn the craft, this is a good way to do it. This is where I would maybe focus on the types of strategies you can do. And you say, well, Dan, what are we talking? How much? You could probably in a $3,000 to $5,000 account max. You could do this because here's the problem, folks. I remember having a conversation years ago with somebody, leading person with big brokerage firm, and I go, Dan, the problem is every 3 months we need new accounts. I said, why do you need new accounts? Well, people trade a little, a few trades, they don't make it, and their account goes dormant. So you need to train them. This is a craft. And so I want to encourage you to use these, stay small, build a foundation, and then go from there. I'll mention at the end, but just so I don't forget, I'll be starting sometime in the next couple months. I was just thinking of this because what inspired all this is I've been doing a small accounts uh, focus at Options Omega. We've been doing we do a morning show. If you go to Options Omega YouTube live every morning at 8:45 Eastern, I think it'd be a great help to you. Uh, Go over different strategies, uh, and you can see the data, like the baseball movie Moneyball. You can see the data, how these work. I think it'd be a great resource for you as you have your cup of coffee in the morning. It's free, 8:45. But we've had this focus, Troy and Matt and Rusty have had the focus on over at Options Omega on the small accounts. And I think that kind of inspired me to, okay, what can you do in SPX and SPY? And it's a craft. And again, if you approach it that way, I think you'll be fine. So let's go through these. Again, this is recorded. You can see it. I'm going to go through 6 strategies just so you can get an idea. Hey, I can practice the craft on the top vehicles. These are all $500 or less trades, defined risk strategy. So let's start the journey. Number one, a calendar trade. This is a good range bound trade. You can see here it's about $500. A calendar is a mixed month spread where you buy the further out duration, sell the closer in. Here I'm selling June 6th. So as I'm taping this on May 31st, so June 6th would be 6 days away. My short, my long is 9 days away. So in a calendar, if you keep 3 days between the long and the short, you could see in a calendar, your strikes are the same. I put them at the money. So an at the money calendar, a little bit more range bound. You can see it's right at about $5, right? And so you can see we're putting it on here, and you can just see from the graph, you make your money between these. You see these vertical lines are expiration break even. So between about 610 and 58.40, you do real well. This is the expiration graph in blue. So this would be, what did we say? June 6th would be about 6 days away from today. June 9th would be 9 days away. So the blue line is expiration in 6 days, and you want it to be in this range here. So that's a calendar trade. And so if you put 3 days between the long and the short, that'll get $500. What's another trade? How about a vertical credit spread? Here, in a $5,900 vehicle like SPX, we're gonna throw a trade on 410 bucks, defined risk, right? So here it's a put vertical credit spread, bull put spread, a vertical spread, credit spread, whatever you want to call it. Here I'm selling, I picked the short strike. You can see here we're at 59.10. Again, I'm selling that June 6 short-term trade, and I'm selling the 57.90 put. And the key is my long or my hedge is 5 points out of the money, right? So with SPX at 59.10, I'm modeling this selling the June 6th, 6 days away, a put credit spread. My short is 120 points out of the money. I'm bringing in $90 credit. My risk is the difference in the strikes, 500 less my credit of 90. So I have $410 of risk. You could see here when I take my cursor down here way under the price, you'll see in the blue it says 410. That's the P&L at expiration. The most I could lose is 410. If you combine two credit spreads, you have an iron condor. Here's an iron condor, where an iron condor is simply, if you look at the current price again, 59.10, and we're going to stay with that short-term June 6th, sell the 6,025 calls out of the money by over 100 points. We're going to sell the 57.60 puts, 150 points out of the money. And we're going to buy our hedges 5 points below the short put and 5 points above the short call. And you bring in $1.55 credit. Let's just call it for easy math purposes. Let's say we only get with slippage $1.50 credit. The difference in the strikes are 5. So for this iron condor, again, in a $5,900 vehicle, my margin or risk is 500 less the credit, 350. If the world ends or goes to a trillion, this is a $350 trade. That's it. That's an iron condor. And so I went over the iron condor calendar. These are some of the key range bound type weekly income potential type trades. Vertical put spread, you could do a vertical call spread. But again, these are all for a small account, which you can do. And then the final one in SPX, before I give you two in SPY, is a 6-day butterfly. Here's a June 6th. What's a butterfly? And basically, in this particular case, this is a balanced butterfly. I'm selling two at the 59.40 strike. I'm buying one at the 5,900, buying one at 59.80. We're at 59.10. You might say, Dan, why are you placing your short at 59.40? And a balanced butterfly, if I were to place it at the short, I want to show you something. If I place it at the short, where we're at right now, 59.10, and keep it 40 wide, so that would be 58.70 and 59.50. What you'll notice with the position Greeks, I'm almost one delta short. So that would give me more room on the downside, less on the upside. So if I want to get it more delta neutral, which I'd like generally as a range bound trader, some short delta, I'll raise my strike up to like 59.40. So I'll go 30 points above where we're trading and then go the same, 40 wide on the vertical. And what that does is get my position deltas closer to zero, right? So that's learning the Greeks, which is very important as you learn to trade. Real quick, if we go over to SPY, now we get in the world of covered writes. This would be a poor man's covered write for 500 bucks. If you did a covered write in SPY, because you'd have to have enough money to buy the stock, you're talking $58,000. I'm giving you something in that world for 500 bucks. So I'm basically going out to June 20, in this particular example, 20 days, going to June 6. So I'm buying June 20s, selling June 6, 6 days out. And you can see the debit or risk would be $500. And all I'm doing is, this is a diagonal. A diagonal, the definition is simply buying further out, selling closer in, different strikes. So I'm buying, we're at 588.50. And I'm simply buying and at the money, 590, selling a strike 3 points higher. And you can see it's kind of got that covered right look to it at expiration. We're currently at 588.50, and you're leaning, like in any covered right, you're leaning a bit long, but it's long deltas. And then the last one, the sixth strategy for the small accounts, here's a double calendar. And this is a great range bound trade, gives you a lot of room. And you can see here I'm buying the June 13, selling June 6, so a double calendar. You're buying the further out, selling closer in. There's 7 days between the long and the short. I'm buying my longs at 598, which is 10 points up from the current price. So 10 points up in SPY to 598 would be the equivalent of 100 points in SPX. So you can see my longs, very wide tent area here. On the downside, I'm buying about 8.5 points down at my short strike is 580. So that gives us about, from the current price of 588.50, about 8.5 points. So that's, like 85 points in the SPX. The current price here is 588.50. Deltas are a little bit long, which you'd like to be with a long Vega trade. And this is $367. So this is like so what I've given you today is like the AAA ball club in baseball. This is where you should be. 500 trades and less. Hang in there for six months, build the foundation, and then go from there. The biggest problem is, again, go back to my conversation years ago with brokerage firms. People aren't going to last 6 months. They're going to trade 3, 4 times, get discouraged, then they'll move on to the next thing. So um, if you're interested, send me an email, Dan at Sheridan Risk Management, and I'll just have a group of names. And then hopefully in the next couple months, I will start just a small accounts class and help you work on this and build the foundation to become a craftsman in the options business. Thanks, folks. Have a wonderful day, wonderful weekend, and we'll see you next time. Appreciate it.